This video will help you understand how to use an annuity split to withdraw more of your non-qualified annuity tax-free. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. If you were to take a one-time withdrawal from your non-qualified annuity, generally that withdrawal is going to be fully ordinary income taxable. However, through the use of annuity splitting, you can actually tap into withdrawing more of your basis from that withdrawal and therefore saving you on income taxes. So in today's video, we'll walk through the specifics on how to actually go about conducting an annuity split. So let's jump in. Now, today's video will not include my 2 cents on the efficacy of using non-qualified annuities as a wealth accumulation vehicle for retirement. Ultimately, while I don't find the mathematics super compelling, I can totally see the argument and value derived for folks maybe looking for greater peace of mind as it pertains to delegating the concern of running out of money to an insurance company, and in exchange, getting guaranteed income for life. If you already know a good amount about annuities, I'll timestamp below for how to go about conducting an annuity split. For everyone else though, to sort of set the stage for what an annuity split is and how it's valuable, we'll cover some basics on non-qualified annuities. The bottom line is people have purchased and probably will continue to purchase annuities for a long time. And so you or your loved ones are probably going to run into needing to worry about how to handle the planning around annuities. In my previous video, which I'll link above here, we broke down the differences between qualified and non-qualified annuities a little bit more in depth. Namely, qualified annuities can be further subdivided into either pre-tax / traditional annuities or Roth annuities. Every other type of annuity, however, is going to be considered a non-qualified annuity. Now, in stark contrast to a non-qualified investment account, a non-qualified annuity actually grows without taxes, which the technical term for that is tax-deferred growth. Your non-qualified brokerage account that you might rebalance within or make trades within actually comes with a myriad of different taxes: capital gains taxes, interest income taxes, dividends, maybe even net investment income taxes, etc. Whereas a non-qualified annuity is free to accumulate without taxes. Money placed into a non-qualified annuity is considered your basis, and it's contributed on a post-tax basis, meaning there's no cool tax deduction or benefits you get with funding a non-qualified annuity. This is the exact same way that a non-qualified investment account gets funded, and both are in direct contrast to how qualified annuities get funded, specifically traditional or pre-tax annuities, meaning you are entitled, barring earning too much income, to take a tax deduction when funding a traditional annuity. Now, while our focus today is on non-qualified annuities, the ability to annuity split is still doable within qualified annuities. Just the tax ramifications that we're trying to mitigate are really only super valuable through the use of a non-qualified annuity split. As it pertains to taking money out of a non-qualified annuity, or any annuity for that matter, there's 2 main ways. There's either a withdrawal, which is sort of an ad hoc, flexible way of pulling money out of the account, or through the use of annuitization, where you essentially trade your value of your annuity for a guaranteed income stream. This is traditionally what people think about when they think about using an annuity for income. In the case of a traditional qualified annuity, if you did an annuitization, all of the income received most likely would be fully ordinary income taxable. In the context of a Roth qualified annuity, if you were to annuitize, all the income most likely would be completely tax-free. As it pertains to a non-qualified annuity, however, if you turn it into an annuitized annuity, then you're going to conduct an exclusion ratio, whereby you'll do a calculation to determine how much of each income payment is attributable to the gain, income taxable, and attributable to basis, not income taxable, tax-free. You'll have a percentage applied to each distribution throughout the life of the annuity until you've reached essentially the mortality expectations. Then at that time, all your basis will have been returned to you, and then all future income is going to be completely ordinary income taxable. Downside is you're paying more in taxes at that time. Plus side, I suppose, is that you're living longer than the annuity company was expecting you to. The other method of pulling money out of an annuity, however, would be through the use of a withdrawal. And that's going to be the focus on how we're going to reduce taxes when pulling money out of a non-qualified annuity. Now, normally, barring any other planning, if you were to take a withdrawal from your non-qualified annuity, you're going to fall into LIFO treatment, or last in, first out treatment, meaning any money you withdraw from the contract is going to be considered coming from your gain first and foremost. And that gain is fully ordinary income taxable. Now there's other provisions, such as if you did a withdrawal before the age of 59 and a half, then whatever you pull out that's attributable to gain, which again is most likely all of it, given that LIFO treatment, it's also going to come with a 10% early withdrawal penalty tax, barring any of the exceptions to the 10% rule. Unfortunately, you're not permitted to withdraw a combination of gain and basis, and definitely not permitted to just withdraw just basis tax-free. It has to come in last in, gain, first out. However, there is a way to indirectly tap into that exclusion ratio we talked about, whereby you can actually tap into some of your basis to avoid all of the withdrawal being considered fully ordinary income taxable. And that's through an annuity split. Most annuity companies, like life insurance companies, will allow you to split your insurance policies into smaller policies should you choose. It gives you a little more flexibility if maybe you want to change the beneficiary over one policy but not the other, or change ownership of one policy over the another, etc. If one does split their annuity into multiple different annuities, the IRS says you must pro rata allocate the percentage of basis and gain to each one of those annuities. For example, you can't have a $100,000 annuity with a $50,000 basis and move all the gain to one annuity and all the basis to another one. You have to move over proportional amounts of each, so that every annuity you theoretically split into has the same percentage of gain and basis. When done correctly through a 1035 exchange, and as long as you wait 180 days after making the exchange occur, aka since the inception of that new annuity, the IRS will consider these as two totally separate annuity contracts. Now you might already see where this is going, but to further explicate how this benefits you from a tax perspective, let's use an example. Let's say you have one non-qualified annuity worth $500,000 and you have basis worth $300,000, aka 60% of the total contract is basis. For whatever reason, let's say you needed $200,000 and you needed to pull it from this annuity. Maybe it's the only thing that you have liquid access to. I don't know. As it stands today, given LIFO treatment, if you were to withdraw $200,000 from this current annuity, all of that distribution would be considered ordinary income taxable. And if you're under 59 and a half in this example, it'll also come with a 10% early withdrawal penalty tax. Again, barring exceptions. Whereas if we split this annuity, one annuity worth $300,000 and one annuity worth $200,000, that 60% basis must follow into each policy. So the $200,000 annuity would have a basis of $120,000, and the $300,000 annuity would have a basis of $180,000. Now we wait that 180 days, and as opposed to pulling $200,000 from a $500,000 annuity, fully income taxable, if instead we withdraw $200,000 from the $200,000 annuity that has $120,000 worth of basis, now we only have ordinary income taxes to pay on $80,000, which still is taxable, don't get me wrong, but it's way less taxable. In fact, it's $80,000 taxable versus $200,000 taxable. And this strategy is even all the more impactful if you're under 59 and a half. Because now that 10% early withdrawal penalty tax is not assessed on the full $200,000 withdrawal if we only had one annuity. It's only assessed on the $80,000 worth of gain in the $200,000 annuity. And to further dial this in, if we were assuming an effective 20% tax rate on any distributions, you'd go from paying $40,000 in income taxes on the first scenario versus $16,000 in taxes on the second scenario after splitting the annuities. And you could continue doing this in the future. The remaining annuity you have, you could further split that up in the future if you needed further withdrawals from them. So from a calls to action standpoint, I would say if you have a non-qualified annuity and you were planning to make a withdrawal out of it now or at some point in the future, you should know roughly what your options are, and sometimes splitting an annuity can make the juice worth the squeeze. It's a lot of work, but if the taxes saved is $10,000, $20,000, $30,000, well, that could totally be worth the hourly rate of an insurance broker to do all the math and paperwork for you. However, if you are going to move in this direction, before you start anything, I would clarify with the insurance company that this is doable, and I would also rope in your tax professional, because they're the ones that ultimately are going to report this to the IRS and have your back if the IRS ever comes knocking thinking you did something fishy. But to clarify, this is all totally legal, so I'm not recommending you do anything fraudulent. That said, it is nice to have the backing of your tax professional with you. So hopefully this was helpful. I'd say drop them in the comments if you have questions, but we had to pause those for now. Best route is probably just to get in touch on the website, diamondassociates.com. Have an awesome rest of your week and have a great rest of your day. Bye.